Nobody on the news will say this to you, but I will. When a central bank warns that an oil shock could unanchor inflation expectations, they are not giving you commentary. They are confessing. They're telling you, in the only language institutions are allowed to use, that the system is entering the part of the cycle where control becomes expensive. And when control becomes expensive, somebody pays. The question is who, and when, and whether you see it coming. That's what this video is about. Not the news. The machine underneath the news. The pattern that is repeated, with almost mechanical precision, across different decades, different countries, different leaders, different technologies. The same stages, the same sequence, the same outcome. And by the end of this, you won't just understand what's happening, you'll understand why the headlines always arrive late. Let me give you the one idea that makes everything else make sense. Modern economies don't run on money, they run on confidence. Confidence that the currency holds value, confidence that energy will flow, confidence that prices will stabilize, confidence that debt can be rolled over, confidence that tomorrow looks roughly like today, and that confidence is not a natural state, it's not automatic. It is actively maintained, constantly reinforced, carefully protected, by institutions, by language, by policy, by the sustained belief that someone is in control, until the moment that belief starts to slip, and the moment it slips, the system stops being gradual, it goes non-linear, suddenly. That's why you get rate hike back on the table appearing out of nowhere. That's why you see pivots that seem to come from nothing. The structure was there for months, but most people weren't watching the structure, they were watching the surface. Here's the pattern. 4 stages, fixed sequence, watch how they repeat. The first stage is the setup. This is the quiet phase. Rates stay low long enough that everyone forgets what high rates feel like. Energy stays cheap long enough that entire industries, entire supply chains, entire lifestyles get built around the assumption that it will stay cheap. Debt expands, quietly, slowly, rationally, because the cost of debt feels almost invisible. This is where fragility is assembled, not in a crisis, in a period of calm. The second stage is overextension. Borrowing grows faster than real production. Asset prices rise faster than wages. Governments expand spending because financing feels painless. Investors accept more risk because years of rescue policies have trained them to expect rescue. The entire system becomes dependent, structurally dependent, on conditions staying easy, not because people are reckless, because the environment has made dependency rational. The third stage is the shock. A real-world constraint arrives. It can be war, an energy disruption, a supply fracture, a commodity spike. The specific trigger varies, but the defining feature is always the same. Prices rise while growth weakens. That combination doesn't just change the economics, it changes psychology, and psychology is where the real danger lives. The fourth stage is the forced outcome. The system demands a reckoning. Policymakers face a choice with no good options. Tighten into weakness to protect credibility, or hesitate and let inflation psychology entrench. Either path has a cost. The only thing that changes is who gets hit first. Borrowers, workers, savers, governments, or markets. That is the machine. Now let me prove it to you, not with stories, with history, the United States, 1970s. After World War II, the dollar sits at the center of everything. Trade expands, industry grows, energy is abundant. For decades, the world learns, deeply learns, that this is simply how the world works. That's stage 1. Then the spending expands. War financing, social commitments, global responsibilities, more dollars issued, more promises made than the system can cleanly support. In 1971, dollar convertibility to gold ends. People call it modernization, flexibility, freedom. But structurally, what it means is this. Trust is now doing the work that metal used to do. That's stage 2. Then oil shocks hit. 1973, 1979. Energy prices surge, inflation surges, growth weakens. That's the toxic combination. But here's the part that most explanations miss. The oil price itself isn't the villain. The villain is what it does to memory. People stop believing price stability is automatic. Businesses raise prices because they expect costs will keep rising. Workers demand wages to keep up. Households change behavior. The print isn't the problem. The shift in expectation is the problem. That's stage 3. Eventually, Volcker tightens. Hard, rates spike. The economy contracts sharply. People lose jobs. There is real pain. But the pain is the point. It proves to the public that the central bank will do what it must. Expectations re-anchor. That's stage 4. Notice the structure. Energy was the trigger. Expectations were the amplifier. Forced tightening was the resolution. Now the United Kingdom. Same decade, different flag. Britain emerges from wartime carrying a large state, powerful unions, and a social contract built on the assumption the system will keep delivering. Policy leans toward keeping things easy. Structural competitiveness quietly erodes. The whole system becomes dependent on stable import prices, especially energy. Stage 1 and 2. The oil shock arrives. Inflation rises. Wages chase prices. Prices chase wages. Markets lose faith in the currency. The pound weakens. And, crucially, people start acting like inflation is the new normal. Once behavior shifts that way, you can't talk it down. You can't argue people back into confidence. Stage 3. Credibility is rebuilt only through constraint, pain, external pressure, and eventually political restructuring. The machine doesn't care about ideology. It doesn't care which party is in power. Stage 4 arrives on schedule. Same machine. Now Weimar Germany. This is the extreme case. But it's useful precisely because it removes all the modern disguises and shows you the bare skeleton. Wartime financing expands money creation on the assumption that future outcomes will cover today's costs. Common human logic. Familiar logic. Stage 1. After the war, reparations collide with fiscal collapse and political instability. The government can't raise revenue in stable terms. Monetary financing, simply printing, becomes the path of least resistance. The currency weakens. Trust begins to erode. Stage 2. External obligations intensify. Scarcity spreads. Confidence doesn't just slip, it breaks. People stop holding currency because holding it becomes irrational. Prices stop being prices. They become moving targets. Stage 3 doesn't just arrive, it detonates. The old monetary regime doesn't just tighten, it dies. A new system has to be built from nothing, because once belief fully collapses, there is no gradual path back. Stage 4 is not a policy response, it's reconstruction. Energy wasn't even the trigger here, but the structure, overextension, constraint, expectation collapse, forced outcome, is identical. Now apply all of it to today. For over a decade, the global financial system lived in an environment of suppressed volatility and historically low rates. Markets developed rescue reflexes, the assumption that central banks would always step in. Governments learned that borrowing could expand without immediate punishment. Households locked in mortgages at rates that seemed permanently cheap. Companies refinanced endlessly because refinancing was always available. The system adapted, and adaptation is exactly how fragility is built, because when an adapted system meets a changed environment, it doesn't gently adjust. It breaks at the weak points. Global debt now sits at record levels. That means the entire world is built on rollover risk. In a low-rate world, a rate hike is a policy adjustment. In a maximum debt world, a rate hike is a stress test applied to everything simultaneously. This is why rate hike talk hits markets like a hammer now, even before a single hike happens. The anticipation alone tightens conditions. Banks become cautious. Credit spreads widen. Borrowing becomes harder. Risk assets reprice. The system begins to feel stage 4 before stage 4 has officially arrived. Now enter the oil shock. And here's why oil is uniquely dangerous. Oil is not just fuel, it is cost transmission. It moves through transport, logistics, food production, plastics, heating, electricity, industrial inputs. When oil prices spike, it acts like a tax applied to everything at once. But the first-order effect, the direct cost increase, is not the main threat. The main threat is second-order behavior. Do firms raise prices not just because costs rose, but because they expect costs will keep rising? Do workers demand higher wages because they believe inflation will persist? Do consumers buy earlier because they fear prices will be higher later? Do lenders demand higher yields because they no longer trust the inflation target? That is the expectation shift, and that is what central banks actually fear, because an oil spike can fade in the commodity chart and still be permanent in the public mind. Here's why oil specifically does this better than almost any other shock. Most people don't track bond yields. Most people don't read CPI component breakdowns. Most people have never looked at a money supply chart. But everyone sees energy prices. They appear on every fuel receipt, every utility bill, every delivery charge, every grocery run. You don't need an economist to tell you inflation is real when you feel it every day in the most unavoidable costs of living. Oil makes inflation visible. Visible inflation becomes inflation memory. And inflation memory changes behavior. And changed behavior makes inflation self-feeding, even after the original cause has faded. That is the psychological fuse. That is why the chain reaction looks the way it does. Energy prices rise. Headline inflation rises. Media amplifies. Households adapt behavior. Wage demands increase. Firms raise prices preemptively. Inflation expectations move higher. Bond markets reprice yields. Policymakers see the shift. They fear credibility is slipping. Rate hike talk returns. The whole chain can begin before a single rate changes. That's the leverage point. That's what back on the table actually signals. Now here's something the original framing usually buries. The central bank's real job is not to fight inflation. It is to prevent the public from giving up on price stability. Because the moment the public gives up, the moment they stop believing inflation will stabilize on its own, inflation becomes a social process instead of an economic one. And social processes are far harder to reverse than economic prints. You can change a number with a policy decision. You cannot easily change what a society believes. So when a central bank warns about unanchoring, they are not predicting the future. They are describing a trigger condition. They are saying, if we see signs that belief is slipping, we will have no choice but to act. That no choice is what makes it forced. That's what stage 4 means. Not a policy decision, a system demand. And now the question every viewer is thinking, how do I see this before the headline? Watch the language. Central banks don't say we're losing control. They say we're watching second-round effects closely. They don't say we're afraid. They say a live meeting. They don't say the situation is deteriorating. They say the balance of risks has shifted. They telegraph through terminology because they are managing belief simultaneously with policy. The moment the language moves toward expectations, second-round effects, and optionality, they are telling you stage 3 is active and stage 4 is approaching. So when you hear rate hike back on the table, stop treating it as a forecast. Treat it as a stage marker. Now let me make this land where it actually matters, in your daily life. Energy prices rise, your fuel costs rise, your grocery costs rise, your utility bills rise, your delivery fees rise, your rent rises because landlords face higher costs and higher financing pressure. Your employer faces higher input costs and either raises prices or looks for places to cut. If they raise prices, inflation persists. If they cut, unemployment risk rises. Either way, pressure accumulates. And the central bank sits watching one question. Are people behaving as if this is permanent? If the answer starts to become yes, policy must lean against it, hard and fast, because once the behavioral loop starts, it feeds itself. That's not a theory. That's Volcker. That's the UK in the late 70s. That's every case where waiting made the eventual tightening more brutal, not less. Here's the most dangerous illusion that always appears at this stage in the cycle. People start saying this time is different. They say modern tools will prevent the old outcomes. They say technology will absorb the inflation pressure. They say central banks are sophisticated enough now to engineer a painless landing. The machine has never cared about those arguments. Debt creates sensitivity. Energy shocks create price pressure. Price pressure threatens expectations. Threatened expectations force policy. Forced policy creates stress. Stress reveals fragility. The sequence doesn't need your permission, and it doesn't respond to optimism. So here is the framework that actually helps. Stop consuming the news as a series of events. Start reading it as stages. Every week, ask yourself where we are in the sequence. Are we still in stage 1, where stability is assumed and debt quietly expands? Are we in stage 2, where overextension is visible and the system cannot tolerate normalization? Are we in stage 3, where shocks are pushing prices up and behavior is beginning to shift? Or are we sliding toward stage 4, where policy becomes forced and stress becomes unavoidable? That one mental frame turns chaos into structure. What you do with that structure is practical. Reduce fragility. Because fragility is the specific condition where one shock, one rate jump, one cost surge collapses your situation. If you're carrying leverage, understand that in a regime shift, timing kills. You can be right about the long run and still get wiped out in the short run if you're forced to sell at the wrong moment. Prioritize flexibility, because when conditions are live, optionality has real value. And stop anchoring to the last regime, because normal is not a permanent condition. It is a temporary state created by stability, and stability, as stage 1 always teaches us, eventually ends. Here is the final point, stated as directly as I can make it. The oil shock is the trigger. The debt load is the amplifier. Expectations are the fuse. Policy is the forced response. The outcome is not optional. It is conditional only on one thing, whether inflation belief holds. If it holds, the system limps forward. Costly, strained, but functional. If it doesn't hold, tightening accelerates, stress spreads, and stage 4 locks in. For real this time, not as a warning. Most people won't see it until after the headlines confirm it, because they are watching events instead of structure, surface instead of mechanism. They're reading the news the way you read individual frames of a film, without knowing what scene they're in. But now you know the scene. The most dangerous moment in this pattern is never when everyone is panicking. It's when everyone decides it's over. Because the machine doesn't stop when the headlines calm down. It keeps moving underneath. And right now, it is moving.